Here. So you should have gotten this in the email, I think. Let me check just to make sure. I'm almost positive I put it in the first documents. Yeah, it's in the course documents too. Okay. So you pull up this thing called Basic Classical Sampling. And this will be kind of an introduction as far as what we, one of the things we do is gathering evidence. And so this is one of the ways we gather evidence that we do sampling. And this is probably something we're a little more familiar with, or at least, maybe makes a little bit more sense, I guess, than kind of the theoretical stuff with auditing. Okay, so basically we have a bunch of accounts receivable, and we have to pick a sample. There's a random number table, which we'll talk about in a minute here. And we're going to pick 5 items. First 2 columns in the 5 items in accounts receivable. Okay. Here's the wacky thing about, or one of the wacky things about auditing, that everything you do in auditing must be repeatable by somebody else, a reviewer, and get the same results. So it must be repeatable with the same, and by someone else to get the same results. Now the judgment might be different. How you interpret what you get might be different. Maybe if 3% of the items have errors, someone might say that's good, someone might say that's bad. That's judgment, but everyone should come up with the same 3%. So that's what we're talking about here. So you have to always document exactly how you did it, what you did, so someone else can come in and do exactly the same thing and get the same results. And the problem with, for instance, when we go through this, so we're going to pick a sample, a random sample. The problem is, how do you pick a random sample and someone else comes by and picks a different random sample? You're not going to get the same results, even though you both pick random samples. And from your statistics class, you guys probably have already had statistics. If you haven't, generally you want a random sample. Random samples are usually the best. They represent the entire population the best if it's random. It's not free from bias, non-biased. So anyway, a random number table, though, is one of the ways you can do it. There are other ways too. But what we're going to do is we're going to have this random number table, and we're going to use it to first choose which ones we're going to test. And then we're going to test and kind of, make a little bit of a, figure out where we're at. Basically, if we were doing an audit, how much will we trust these accounts and the balances and all that kind of stuff. Okay, so getting back to this thing. Okay, so there are 30 accounts here. And we go down to this random number table, and this is really what they call a random number table. It could also be a random digits table. If we were to try to use the account numbers to match them up, it would be really difficult. It'd be searching all day through these, to find numbers that match up to these numbers. So what you sometimes have to do, and that's what I did here, is say, okay, well, we'll renumber them ourselves and then pick the sample. So sometimes it's important to, they call them, massage the data, get the data into some format that you can actually use. So renumbering is not that uncommon of a thing. And a lot of times if you're using computer systems, there'll be record numbers there anyways. So you can just use those. But anyway, so I'm not going to try to match these up. It would be impossible. So, but these over here, if I renumber it, I can do it. Okay, so this random number table. Now, this random number table it's really what they call random digits. Each one of these is completely random. Okay. So anyway, saying that, you could pick from this column, or this column, or whatever column you want. Now we have 2 digits here, so we're going to have to pick 2 digits. So this one is, it says we're going to use the first 2 columns. Okay, so these are the first 2 columns, and we are going to try to find numbers 1 through 30. We're going to find the first 5 that we come across, 1 through 30, using this random number table. So, is there a number 3 that we can pick? Yes, there is. Here's number 3. So we're going to pick number 3 as our first item. Is there a number 46? No, it only goes up to 30. So there's no 46. There's no 51. There's no 32. There is an 11. There is a 14. There is an 18. There's not a 91. There is a 28. And we got 5, right? 1, 2, 3, 4, 5. Okay, so notice what we did. It's a random number table, so we picked a random sample. Why? Because it's the best. It's the best indicator of what the population of a whole is going to look like, is it's not biased. But notice that by saying that we use the first 2 columns, everybody using the first 2 columns will pick the same 5 items. So it's a random sample, but everyone's going to pick the same random sample. So if your supervisor comes through and says, okay, I'm going to check your work, they can go through and okay, the sample you picked is that when I pick the sample, it'll be the same as one you picked, and so on and so forth. And by the way, your work as an auditor oftentimes gets checked for different people, 5 different people maybe. It'll get checked, we'll talk about later, but the senior, the manager, the partner, maybe a reviewer will look at it. There might even be a reviewing partner. So a lot of people look at these, and they should all be able to, come up with the same thing that you did. Again, the judgment might be different, but whatever the results are of the test, they should all be the same, and that's why one reason why they do it this way. Okay, so a random number table, we picked 5 items. And so I'm going to just copy them down here just to get them a little bit closer. Hope this works. Hey, I think it does. Oops, that shouldn't be there. Okay, so that is a random sample. I know it's probably the first time you guys seen this, but is there anything on this that, any questions you have so far? So far, we just picked the sample. We haven't done any testing of it yet. Okay, so the book amount, those are the amounts that the client claims that those accounts receivable are worth. And we would call it some management assertions, which we'll get to later. But the management, when they give you a document like this, it's assumed that these are all correct, that they believe that these are all the right amounts for these accounts. So what we have to do is go into each of these items from our sample, and as auditors, we'll go through and check the information in the background. So I got a little dog that runs around like a maniac, and she just crashed into something upstairs. But anyway, so we'll get the documentation information. There's a number of things we'll look at. We could look at the invoices, the bill of ladings, to make sure they've been shipped, and all kinds of stuff. We're not going to worry about that right now. But what we do is we check and we say, okay, if you say that this accounts receivable is worth $5,000, let's go in and see what this thing is really worth. Yeah, it might be worth $5,000. It might be worth something else. But we have, as auditors, we have to go in and see what the actual amount is that these people owe you. For one thing, you could be just making up, accounts receivable and putting on the books to make the company look better. Okay. The little dog just crashed, and then I think sometimes she crashes and then just lays down and goes to sleep. Okay. All right. So we go to the first one. And the first one, it looks okay. The book amount was $81.83. The audit amount is that. So the first one is okay. We go to the second one. And the second one, it's okay. Go to the third one. Third one is not okay. Oops. Hold on a second. Let me get that clear. So I notice the third one here is, they say it's 7607. We look at it, we say it's 7207. So we get a little bit of a discrepancy there. Go to 18, and we come up that it is off by $1,000. So this one is off too. Also, the last one looks okay. Okay. So we've taken our sample now. And now we're going to try to make some sense out of it. So we've taken the sample. We're going to now, the same sample that whoever else comes through will take the same sample, blah, blah, blah. Now we have to see, okay, what is this? What are these accounts receivable really worth? And we have to figure out how are we going to take this sample and project it over the population as a whole, which is kind of what sampling does. And this isn't just for auditing, for any kind of sampling. They take a sample, Well, the vaccines, for instance, they take the sample of the vaccines and they test on a small number of people and see how it works. If it works, they go further and maybe do more tests and all that. If it doesn't work, they say, okay, forget about it. We're going to try something else. So, but you take a small sample, and when you're talking about things like medicine, you can't just there's 7 billion people on the planet. There's no way you could test it on everybody. So you take a sample of people and then you project it over the entire population. Okay, if this works with 60% of the people, we project it, 60% of people of the entire population will work. Whatever it is, you take this a smaller sample and you project it over a larger one. It could be anything. It could be how much do the ducks on the pond weigh? You go pick up some ducks and you weigh them, and okay, we now know about how much the entire population of these ducks, all that kind of stuff. So it could be anything. In this case, it's accounts receivable. So what we're going to try to do is get an average here for each of these. So we have the average for the book. Let me do something first. Let's get a total, and then we'll do the average. Oops. Okay, so the total for what is I do my document camera. Okay, 8183 plus 7982. Seven six oh seven. Six. 33,795. You may want to check that. Okay, so for that one. For this one would be $32,395. Is that what you guys got?
Yeah.
Okay. All right, and so we're going to divide it by the number of items. All right, which is 5. And this will give us our averages. So this is 5. So this will be our average. $64.79. 67.59. Okay. So this would be our book average. And this will be our audit average. By the way, just now think about this, just kind of in general. Which number is more convincing? The book value that the client came up with, or the audit value? As an auditor, which one of those is the most convincing? The work that was handed to you, or the work that you did?
The work you did.
Yeah, the audit. The audit, you know, so information that you get yourself is more convincing than information someone else gives you. Just because you know the source of it, you know how it came about and that sort of thing. So whenever you're doing an audit, the stuff that you obtain yourself is always more convincing than the stuff you get secondhand, like, you know, like the book values here. They came from the client. Okay, so these are the averages. So lazy and cut and copy those. The book average is that. Average is this. And again, this number we're a little bit, well, not a little bit, we're definitely more, it's more convincing, it's better evidence. Simply because it came from us and not secondhand from somebody else. Okay, now the question becomes, how do we take these numbers that we have and spread them over this entire population? You know, there are 30 accounts here. And we have to say, okay, we're taking the sample and now we're going to spread, so project this over the entire 30 items in the sample, see what we think that the true value of the sample is. And we're going to start on the next page here. And I'm going to copy these down, well, down to the next page just because we're going to need them. Okay. Using the audit average and the book average from the previous page, calculate projected values, same using the 3 classical sampling methods. And this is called classical sampling. The total book value of the accounts is $200. Okay, so I just made this one up, so I ran out of space here. But if you were to add all these up, all these book amounts, if you were to add all those up, they come out to 200,000. So here, as auditors, we're looking at this 200,000, saying, well, you know, is this something that we can, you know, is this number, is it close to that? You know, if it's close, remember, we look at things that are material, we're probably fine with it. But if it's not close, then we might suggest that they make some changes to the number. Okay, so coming down here, so this is how we actually do this for the mean per unit estimation. There's 3 different methods. So we'll talk about mean per unit. Just to jump ahead here. Ratio estimation. The following page will have difference estimation. And these are the 3 methods. These get tested occasionally on the CPA exam. They don't hit them tremendously hard, but they do hit them sometimes. I mean, they'll definitely throw questions out there about them. They might give you a big problem, but usually this kind of stuff is tested in the multiple choice questions, which are worth 1 or 2 points depending on how hard they are. Okay, so what we're going to do is we're going to take the audit average. So in this case, 64.79. And we're going to say, okay, well, we came up that the audit average is 64.79. And we're thinking that everything in that population should be the same as our audit average. So everything in that population should be 6479. And there are 30 things in that population, right? This is the total amount of items in that population. So we're saying that all 30 of these should be worth what we came up with. So that's kind of, this is the mean per unit estimation. So there's 30. And this will give us the projected value, what we think that the entire thing is worth. Let's see here. So it's 9. Let me divide times 30. 194, 370. So this is our projected value. Oops. So the projected value is 194. So this is what we think that the is the best estimate of as far as what we think that they're the true value of these accounts receivable are. So coming down here, they have a book value of 200,000. Oops. Our projected value is 194, 370. So how much is the misstatement? What is it? 5,000. 5,630. So this would be the projected misstatement. So the client says it's worth 200,000. We did our work. We think that it's more, according to this method anyways, it's closer to 194,000. And the difference is 5,000, whatever, a little more than 5,000, 5.5. So this is the misstatement. Are their books overstated or understated? According to what we did. Do they have more on the books than they're supposed to, or do they have less on the books than they're supposed to?
They have more.
All right, it's overstated, yep. So these would be overstated. They're overstated by 5,630. They have 200,000 on the books. We say it should only be 194. Now, the question is, well, is that material or not? It really depends. Depends on the auditor. It's a judgment call. One of the things about the CPA exam, just to jump back to that for a second, is that they generally don't put a judgment. You know, they don't ask you to make a judgment unless it's something ridiculously obvious. They don't ask you to make a judgment about whether $5,630 is material or not. They're not going to ask you that. But they will ask you what would be the projected misstatement, what would be the projected value, that sort of thing. They'll definitely ask you that. Okay, and again, you know, doing an audit, when you come up with this, someone else should be able to come through doing exactly the same thing, come up with exactly the same misstatement, whether it's material or not is a judgment call. Okay, so this is mean per unit one. Ratio estimation is one that basically says this, that large dollar amount items will have larger errors than smaller dollar amount items. You know, an account that it has $5,000, it wouldn't be that unusual to be off by $200. If there's a $40 account it probably is not going to be off by $200. Might be off by $2 or something, you know, but it's not going to, the idea is that bigger accounts, bigger errors, smaller accounts, smaller errors. So that's kind of what this ratio estimation is that there's a ratio of what these are off by. And you always take the audit over book. If you forget which comes first, do it alphabetically. Audit over book. Okay, so let's see. The audit amount is this. And the book amount is, oops. That. And so what the ratio estimation is telling us is that, look, everything in here is off by a ratio. The large things are off by more dollar amounts than smaller things are off by. And so that is what we're doing here. We're getting a ratio of what these are off by. And so this is going to be the audit value divided by the book, multiplied by the total book. And that will tell us what this projected value really should be. So the total book was 200,000. Yeah. So 200,000. And that will give us a projected value. Okay, so let's see. Divided by I'm gonna round off the nearest dollar. 191,715. Is that what you guys got?
Yes.
Okay. So that is our projected value. And a projected misstatement will be whatever the difference is between those. $82.85. Okay, so here is the projected misstatement. See the easy. It's a little bit high. All right. Oops. And overstated, understated. What do you think? Actually, it's the same as before, right? I mean, we think that it's worth less than what they have in the book, so this is overstated. So they have overstated their books by 82.85. And again, is that material or not? It's a judgment call. Now, certainly that one is higher than this other one. So it depends on the method. And one thing you'll notice about these methods is they don't always come out to be the same. In fact, it's not unusual to have them come out by quite a bit, quite a bit of a difference. And we'll explain what, and later on I'll talk about when we use which one. Okay. So we are just trying to get this spread over the population. So ratio estimation, it says everything is that large items will be up by more than small items, which is kind of intuitive and probably the way most things work. However, the last one here, difference estimation, is that items will be off by the same amount if they're off. And this is something, for instance, let's say that it's common, or a common mistake that people make at some companies, that they don't charge the handling fee. There's a handling fee that's supposed to be charged and they forget about it. So that, if it's a $50 order, they don't charge the handling fee of $5. If it's a $50,000 order, they forget it. So that the amount that is off by is often the same. That's when you use this method, the difference estimation method. And you take the audit average. And you subtract the book. So here's the audit. Here's the book. And we're gonna get a difference here. So 67, whatever that. Let me. $64.79. $280. So, in other words, we're saying that each one of these is $280 too high. Right? We should subtract 280 from each one of these items. If there's 30 of them, that each item that has to get $280 subtracted from it. So 30 times 280. 8,400. Now notice this one is a little bit different than the first two because we actually go to the misstatement first. So this is going to be the misstatement. This should be subtracted by 8,400. So the misstatement is 8,400. Oops. It's 8,400 too high. Let me take that negative out. And we're saying that this is overstated. Each one of these items is $280 too high. So if they have 30 of them, it's $8,400 too high. So this is going to be an overstatement of, oops, not that, 8,400. Now it gets tricky though, because we have a book value of 200,000. We have a misstatement of 8,400. And so we have a projected value of what? What would be the projected value? Anyone? So you come up with this, you say that, let's see. Yes, that is absolutely right. 191,600. 191,600 is correct. Yeah, so this one you got to kind of back into it. It's you come up with a corrected misstatement first and then back into that one. So this is different estimation, and this is sort of the opposite of ratio. This says, okay, everything's going to be off by the same amount. Doesn't matter how big the account is. $50 account or a $50,000 account is going to be off by the same amount. And there are scenarios where that would come into play. But anyway, the idea is though that it really depends on what you're looking at. So what you're actually looking at, it makes a difference. Okay. All three classical sampling methods will estimate the projected value for the. Hold on a second. Okay, so all three classical sampling methods will estimate the projected value. That's actually true. I think I left out the word will estimate the same projected value. They will all give you a projected value. Yeah, add same in there. The way it was written before, though, is true. It'll give you a projected value, but it won't be the same. And that's false. They're all going to give you. Well, they can. It could be just a coincidence that they don't. But they oftentimes will not. And I would say probably usually, unless you have something strange happen, they would be the same. It could happen. It's not impossible, but it'd be unusual. Of course, on that. Okay. Let's go ahead and do one more. We'll go into something different. Now, usually, you're taking the CPA exam, they're not going to give you something like this. They're not going to give you a huge, bunch of data that you're not going to use. What they usually do is they'll say, okay, more like this. Even this would be, it would probably be unusual a little bit, but here's the items in our sample that they picked for testing. So there's a total number of them of 1,000, and we picked 10. And these are numbers. So first thing, now again, this hasn't all totaled up, so we don't actually have to go pick these. I'm going to add them up. This will be so there's a sample size of 10. And what is the average audit of? Oh, the average audit value of it. Let me get these up closer. So what's the average audit amount and what is the average book value? So all we're going to do is take these and divide it by 10. Okay, so the audit one comes first here. So this is the audit. Okay, so the average audit would be 53.40 divided by 10. Oops, that's not 10. Equals 5,000. Okay, yeah, 5,000. I think this one came out of a CPA exam. Ah. All right, so this would be our average audit amount. And we're going to do the same thing down here for this one. $5,040. Okay. And this, quite honestly, this is probably about as involved as a CPA exam will get. I can't guarantee that. Obviously, they can do whatever they want, but they usually don't go too crazy into actually physically picking the sample and all that kind of stuff. Well, if you're doing auditing, though, you have to know how to do that, but they really usually don't go too far into it. Okay, so we're going to do the same thing for here. Is we're going to split them up. And I'm going to copy these down just to close by. Okay, so why don't I be quiet and see if you guys can figure these out. The mean per unit, the ratio, and also the difference estimation. This is the total amount of the accounts payable. I kind of walk through the first one. Yes. The audit amount was this. I have these all. Oh. And so in this 1,000 though, this comes from the previous page. So we have 1,000 of them, and we say that those 1,000 of items should be exactly the same as what we came up with. Okay, now I will be quiet. Okay, I think that's what you should have gotten for these. You can check my numbers too. I got them wrong. Anyway, the mean per unit, we say the projected value is 5,314,000. You only have 5 million on the book, so would these be overstated or understated? The client's books, would they be overstated or understated? What do you think? Excuse me. They have too much on their books or too little?
It's still understated.
Yeah, it's understated. They should have 5,314,000. They only have 5 million on the book. So, and all these you can see are going to be understated. The ratio one, my calculator only goes up to 6 digits. So if you have 261, that's probably more accurate than what I have. So these are all going to be understated. And then this one down here, of course, is we're saying that each one of these is understated by $174. So you can add $174 to all 1,000 items. So that every item on there is off by $174. So if you have 1,000 of them, it's off by that. And I think that this is one of the more involved ones. I think this came off of CPA. I'm almost positive it did. By the way, just so you know, a little bit of yeah, I'm sorry, the quiz we did last week, that is that we did that last week. Actually, I think it was already done. I think you just have to, I didn't have to send the file back in. I think I accidentally sent you out one that was completed. So yeah, you just have to send the file back in. They're not all going to be that easy, but for that one, yeah, you just send the exact same file that I sent out last week. The what was it called? Beginning of semester information and quiz. Yeah, just send that in. But yeah, so this yeah, I'm almost positive is just a brief history. We'll go ahead and take a break. But the CPA exam used to be an open exam, and what I mean by that is that you could get the questions from it up until 1976, which I know was like before when you guys were born, mostly. But the they used to be an open exam. You'd go in, they'd give you an exam booklet, and then they would give you the answer. The answer booklet we put in. So you'd have the exam and then the answer booklet. You'd complete the answer booklet, turn that in. You'd have a self-addressed stamped envelope. They'd put the exam in and they would mail it to you. You'd actually get back the exam you took. And you mean they would get the answer thing back. They would keep that for grading. But anyway, so there are actually a lot of actual CPA questions out there for stuff like sampling. Sampling hasn't changed, you know, in the last 25 years or whatever. It hasn't changed. So there's actually quite a few real CPA questions out there for a lot of different things. A lot of the auditing, you know, a lot of the auditing stuff that we do is exactly the same. There's some new stuff, don't get me wrong, but you know, a lot of the actual procedures are the same, and this is one of them. Sampling hasn't changed. So there's quite a few actual sampling questions that are something that you get in a CPA exam. And by the way, one of the things too about back in the day when I took it, a lot of times you did have things like this that you could do these in your head because they didn't allow calculators. You couldn't use calculators on the CPA exam. I know it sounds crazy, but you could use pencils and erasers. That's what they allow you to use. So you did get a lot of these really nice big round numbers, and you knew if you came up with some weird number like 52.37873, you knew they get it wrong. You didn't go back and take a look at it again because they would never give you something like that. They give you these great big nice round numbers. Okay, so let's go ahead and stop, and then I think when we come back we'll start with the we'll start with the handout that we started last week.
I have a question.
Sure.
For the difference estimation on the one that we just worked on, for the projected value, wouldn't that be the 5 million minus the 174,000?
Actually, this one's a little bit different in that the audit amount is higher than the book amount. So we're saying that the book amount is 174 too low. So we have to add 174. Let's take a look at it. It's an excellent question. Let's go up and take a look at the first one and see how it was different. On the first one, man, is that small? On the first one, the audit amount was smaller than the book value. You know, the book value, the audit value was 64. The audit value was 67, right? So it was smaller. So we said, okay, this one is, you know, they're overstating it. Scratch that. Each item is being overstated by 280. You have to subtract it out. Down here, we're saying, okay, you don't have enough on these. You know, look, it should be 5,314. You got an average of 5,140. You're missing this 174,000. So this is $174 each times 1,000. Each item is being understated by that amount. So you have to add it to it. So yeah, it depends on whether the audit amount is higher or lower than the book value. So if it's higher, you have to add it on top, right? It would be added to it. And in this case, we're saying that the average audit amount is 314 compared to their 5,040. And again, remember too that our audit amount carries more weight. You know, it's a better number for us. It's a more persuasive number than what they gave us. We looked into it, and that's what we came up with, was 5,314. That's more persuasive than something somebody gives you secondhand, like the book value. So yeah, it depends on whether the audit amount is higher or lower than the book amount. If it's higher, you got to add it back on. If it's lower, you take it off. And so you kind of look at these. If you look at these, if you just think about just in general, that in this case, we think that there's more compared to what the client has in their books. Yeah. So yeah, it is a little bit strange. And by the way, one of the things too that I'll tell you, then I promise I'll shut up, is that the CPA exam, a lot of times when they do ask the questions, they'll ask whether it's understated or overstated. That is a common question on there. So if the audit amount is higher, it's going to be that they're understated. They're not putting enough on the books. If it's lower, it's going to say, okay, you have too much on the books, you got to take some off. And not to, if you look at this, this is something, this is one of those things that, this is accounts payable. The first one was accounts receivable. Accounts payable, this is when you owe somebody else money. It's more, if a company's trying to make themselves look good, it's more common for them to try to not put all the accounts payable on the books that they should. So, you know, sometimes if they're trying to make themselves look more profitable or something like that, they'll have less of the accounts payable on the books. So understating the accounts payable is a way to make themselves look better. It's a kind of a fraud. Well, I shouldn't say it's fraud. It could just be random, you know, whatever, but it could be. I would say that is something that you would think about if you're committing fraud, saying, well, why don't we reduce the accounts payable? We get a bill in the mail, we hide the bill, don't put it in our system, and, you know, try to underestimate what we have, what we owe to people. Okay, so let's go ahead and stop there. And when we start back up, we'll come back to this thing. I think we were on page, oh, so it's right there, the CPA firms. So we will say, be back in, what the heck is it? Say be back at 7:20 maybe. And we'll start up here. We'll go let my crazy little dogs out. Okay, we'll go ahead and get started. Talking about CPA firms. The CPA exam is for CPA firms, so a lot of times that there's the structure of the CPA firm that is actually important, you know, and important on the CPA exam because they it makes a difference as far as how they do the exam. So there are some things on in the how CPA firms are organized that we want to go over, and I'll talk a little bit more about some of those. So local CPA firms. A local CPA firm, say probably 1 to 10 partners. It could be one person. You pass CPA exam, get licensed, you can set up your own CPA, you can do, you know, your own business, do taxes and all that kind of stuff. Usually the size of the client matches the size of the firm. So usually smaller firms will have small businesses as clients, or individuals that do, you know, individual taxes and that kind of stuff. Not always, but for the most part, you know, you match up. So a smaller firm usually has smaller clients, larger firms have larger clients. And so as we go through here, we'll kind of talk about these a little bit more. So local firms, these are firms in one area, usually 1 to 10 partners. It's not unusual to see places that have, you know, 1, 2, 3 partners. That's not unusual at all. And again, you pass CPA exam, I mean, you know, go into business for yourself. Regional firms. Probably like 5 to 20 partners, somewhere in there. Oops. And these are usually in, oops, forgot a T. They may be in more than one state. For instance, maybe they do, you know, Illinois, Wisconsin, and Indiana. You know, that would be kind of a logical kind of grouping because they probably have clients that have, you know, that could be along those border lines and so on. So more than one state, not stating. National firms. These can have hundreds of partners. So yeah, probably have probably hundreds of partners. And these will be in most states. Maybe not all states, but most states. Okay, now, so here's the thing. If you're, you know, if you have a business that spans more than one state, you're probably looking at, you know, using a regional firm to do your audits, right? It would be one of those normal things would be to have a regional firm. If you are in virtually every state, you probably want to have a national firm do it because you have to have offices basically in all those states for them to do the work in those states. So national firms are ones that, you know, are pretty much in every state or close to it. And they'll have offices in all the states, so that, you know, the larger the client. So if you have a national, you know, a client that's a national client, they'll go with these national firms because they need to, you know, they have to have most states. And also, you know, one of the things too about local firms versus regional firms and all this is you kind of go up. Local firms generally don't do too much in auditing because they don't need to. They're not, a lot of times their companies are not listed, and, you know, they don't have to put out financial statements and that sort of thing. So a lot of times you'll have like smaller firms won't do very much in auditing. As they go up bigger and bigger, they do. You know, they go, you know, you get these larger firms, they will do more. National firms may very well be listed. And, you know, if they're listed, you know, on the stock exchange, well, they have to have audit. So as the firm size goes up, as the company size goes up to being audited, the firm size goes up. And then the big four, and these are, you know, they could be hundreds or thousands of partners, would not be unusual. And these would be international, they all over the world. And again, you have very large companies. You take a company like Ford or something like that. They have manufacturing plants all over the world. If you're going to audit Ford, you have to have offices all over the world to, handle the audit. So international firms, the big four, generally the international firms that we have, those firms are the only ones that can do a lot of these really large companies. The only ones that can do their audits are the big four firms. Okay. Which of the following types of CPA firms would be appropriate to form an audit of a bakery that has operations in Illinois and Indiana? Which size firm?
Regional.
Yeah. Yep. Regional firm, probably the one you want to go with there. You could do, one of the bigger firms, but usually you kind of match it up. As you go up in, to these national, international, the prices go up too. So if you just need an audit, a lot of times regional firms would be the way to go. Okay, CPA firm positions. There are 4 categories that the ACCPA uses for positions in a CPA firm. They use the assistant, those are staff assistant, sometimes called staff associate. That's where you come in and you have 0 to 2 years of experience, and that's where you start out. Everybody starts out there. Then you go to the senior level. People who run the audits, which we'll talk about up and down in a second here, managers and partners. So there's 4 categories. The AICPA recognizes those 4 as being categories. To the extent that you might say, well, our CPA firm isn't organized like that. The AICPA says, well, get it organized like that. So they have to, whatever people you have working for you, they have to fit into those 4 categories. So whether your company or your audit firm is organized like that or not, the AICPA doesn't care. They say, okay, well, find which category they go into. So these are the 4 categories. Okay, so the first one is staff assistant. Starting position. They do not need to be CPAs. And basically you do what the seniors tell you to do. So staff assistant, this is kind of where you start out at. Something called staff associate. But there's a starting position. You're going to be supervised, obviously, and you are. It's a professional position, but you do not need to be a CPA. Okay, senior. This is kind of the big one. I'll tell you why. In a second here. Okay, this is. They need to be CPAs. And they'll run at least 1 audit. The CPA exam is aimed at this level of CPA firm. And if you think about it, it makes sense. So a senior, these are the people that are running the audits for the first time, right? As a staff assistant, you're not running an audit. A senior, you are. You're running an audit as a senior. So these are the people they want to test to make sure that they are able to perform the audit, complete the audit in a professional manner and all that kind of stuff. So the AICPA exam is aimed at these people. Managers should already know what they're doing, partners should already know what they're doing, but the seniors are the ones that the AICPA exam is aimed at. So when you're taking the CPA exam, that is what it's aimed at. It's aimed at those people that are going to move up to become seniors. Now, if you're an assistant or associate, you are going to be told that, look, if you want to move up, you got to pass the CPA exam. So you're not going to be made a senior until you pass the CPA exam. You can't be made a senior because you're going to sign off on audits. So the senior level is a level the CPA exam is aimed at. You can't be one of those unless you are a CPA. Okay. Managers. They must also be CPA, obviously. They'd be oversee and they'll oversee several audits at a time. They're basically there for the partners so that seniors and that will have someone to go to, they can talk to about if there's a problem in an audit or if they don't know how to do a certain thing, something strange comes up, whatever it is, managers there, they'll oversee the audit. So the seniors report to the managers may have 2, 3, 4, however many seniors underneath them. And they'll be monitoring all of those audits at the same time. Partners. This is the highest level. And partners, their job is to bring in clients. And that is basically all their job is to bring in clients. So generally speaking, partners, well, they will look into the audits, they will oversee what's going on, they'll review audits and that sort of thing. They don't do that at all. But really their job is to bring in more clients. And that's, by the way, making partner in a law firm or whatever it is, that's how you become partner, by bringing in clients. It's sort of like it's kind of like a high-end sales job. If you're the CPA firm, there's the way that you become a partner is by developing those relationships and bringing in clients. And you might belong to a couple country clubs playing golf. You don't like playing golf? Well, it's part of the job. So whatever it is to bring in those clients, that's what you do. So you'll notice something about that, though, about the way this is laid out, okay, staff assistants. Notice it's 0 to 2 years. It's not 0 to 20 years. It's 0 to 2 years. And you'll notice the seniors, 2 to 5 years. It's not 2 to 50 years or whatever, it's 2 to 5 years. And so on and so forth. And what does that tell you? That tells you that basically in CPA firms, it's up or out. That if you're assistant and they can't make you into a senior, you're out. That's not so bad. They'll try to find you usually they try to find you someplace with a client. So let's say IBM's a client. They'll say, look, we got this assistant here that we don't have a spot for them, and moved up as a senior, can you use them? They say, yeah, send them over, so a lot of times you actually get treated pretty well. Being kicked out is sometimes the best thing that ever happened to you as far as a CPA firm is concerned. Because they just give you a job with a client. A lot of times they'll move you up in salary, they'll move you up in, and coming from a CPA firm is kind of highly regarded in the accounting field. So coming out with a couple of years of experience in a CPA firm, you might jump ahead to someone who's, have responsibility, someone who's been in working their way up for 8 years. It's a very highly prized thing for people to have CPA, working a CPA firm experience. So, if same thing, if you're a senior and in 5 years, if they can't make you into a manager, it's up or out. They'll try to find you a spot, with a client or something like that. They like doing that. They like to get their own people inside these companies. Makes the sales a whole lot easier, but it's up or out. And you might say, well, that's kind of cruel, and why? Suppose you have somebody that's an assistant and that really does a great job. They're always there, they do great work, but why don't you just keep that person on, right? They're doing great work. You can't, and here's why. Let me do it on the camera. I'll do it on the document camera. It has to do with let's do with this. Before I start writing. So you have a CPA firm, and here you have partners. And underneath them, you have managers. Underneath them, you have seniors. And underneath them, you have the associates or assistants, depending on, so and by the way, this is true for all partnerships. If you let somebody stay in these positions, pretty soon these will all be locked up. There'll be no one new coming in. They can't be moved up. And notice, if you can't move the people up, partners don't live forever. It'll be the end of the partnership. So because you have to have partners to survive, you have to have somebody that will bring in the business. You cannot have these slots plugged up with people who can't be promoted up. So this is why, they talk about it being up or out, because partners don't live forever, and you need to have partners to move up to become partner. It's something like 1 in 100 become partners. So you can't have these, because it's going to take a lot of people going through here to get one of those. And again, this is something that's common. Now, being a CPA firm, it's a lot of work. I mean, during the busy season, they'll tell you, on Sunday, just come in at 9. And Sunday you just come in at 9, leave at 5. But the rest of the days are all 12-hour days. But so a lot of times people know that they're not going to become partner, or really they want to do this for the rest of their lives, and so they do jump off. But CPA firm is a very good experience, and so up or out, while it sounds very callous and cold, generally speaking, it's not as bad as you'd think. I mean, and a lot of times, you go to a job that's, hey, it's 9 to 5. Hey, I can work from home. It's a lot better than you're used to. Okay. Okay, so, and again, the ACCPA exam is really aimed at this level, the senior auditor level. Those are going to be the new CPAs. And all they have to. Okay, yeah, we'll see what we get through here. Okay, overview of general auditing standards. I think we talked about this a little bit last time, but yeah, let's go through it. The ACCPA, they make rules for private and issuers, public audits. So they actually cover both. Now, non-issuers are solely responsible to the ACCPA because they're not covered by the SEC. Non-issuers are small. If you don't list stock, the SEC has no jurisdiction over you. I think we talked about this before. ACCPA, are they a government agency?
No.
Nope. Yeah, it's a club. And become a CPA, they'll say, do you want to join our club? Can they revoke your license?
No.
Nope. They register CPA firms. Nope. Creates a CPA exam.
Yes.
Yes. They create the CPA exam and every state uses it. They don't have to, but every state does, and they're probably not going to stop that. By the way, and just in case you're wondering, you take the CPA exam, generally speaking nowadays, it's much easier to go from state to state. You can generally go from one state to another state. The reciprocal agreements are basically all over the United States now. Back in the day, they weren't like that. States try to keep all the other CPAs states is bad, but nowadays it's pretty much interchangeable. So I say that if you say, okay, I'm going to graduate and I'm going to go to Alabama or something like that, generally you can pass the CPA exam in more than one state, and you can actually be licensed in more than one state. I mean, the only problem with that is you got to pay the fees for more than one state. So you can actually get licensed in one state and also be licensed in another state. You can be licensed in both states. Again, it's free, whatever it is, $300 every couple of years, whatever it is. So I mean, it does become expensive, but you can actually do it, and you can also have your CPA, take it to another state, be licensed in another state, and then give up the one license, in the state that you're not in. So if you're in Illinois, you move to Alabama, you can give up the Illinois one and keep the Alabama one, and come back to do it in reverse. Okay. State laws. State laws, obviously, CPA rules, they make laws for both of them. Again, just because the federal government might have different laws doesn't mean you don't have to follow the state laws, though, if that's where you're incorporated in. So all corporations are incorporated in some state. You have to follow the state laws if you're incorporated in that state. So if you're incorporated in Florida, you have to follow the Florida laws. Texas, whatever it is. Okay, government agency. Yes. Issue or revoke CPA licenses.
Yes.
Yes. Register CPA firms. Actually, this one's no. They don't register them. The federal government registers them to audit for issuers. Create the CPA exam. They don't create it. They use the CPA exam made by the ACCPA, but they don't create it. And they probably never will, to be honest with you. They could, there's nothing stopping them. They could say, we're gonna make our own, but they probably won't. All right. Public Company Accounting Oversight Board, they make laws for. I'll give you a clue, only one.
Issuers.
Yep, issuers. They only have jurisdiction over issuers. If you are not publicly traded, they have no jurisdiction over you. Government agency? Yes. Issues or revoke CPA licenses? No, they don't issue them, they can't revoke them. Registered CPA firms?
Yes.
Yes. Oh, what am I doing? I did it wrong. Bad teacher, bad teacher. Here we go. Yes. Create CPA exam? No. So they do register CPA firms to audit issuers. They can't revoke their licenses. They can revoke the registration though. So even though they, they can't take the license away. If you're a large CPA firm, if they take away your ability to do audits of issuers, that you're pretty much, it. So they have tremendous control over CPA firms that they do control. Okay, let's go to, we'll go through some of this stuff here. All right. And chapter 2 is actually kind of interesting. It has quite a bit of, it really gives you kind of a feel for it. What type of misstatements do auditors look for? I think we talked about this last time. We only look for misstatements that are, starts with an M.
Malicious.
They could be malicious. We talked about, maybe we did. Material. So we only look for those things that are material. In other words, relevant to a user. And again, it goes by how, the size of the place. $1 million might not be material to some company, but it may be very material to another one. Okay, characteristic of an error versus characteristic of a fraud. When you say something is an error, what is that? If you do something in error.
A misstatement or
It could be a misstatement, but just in general, if you do something in error, did you intend to do it? Usually not, right? I mean, that's not, it could be reckless, but generally speaking, an error is unintentional. Oops, I put this, I recorded the stapler at $6,000 to $6. So the characteristic of an error is that it's unintentional. You can guess what's the characteristic of fraud.
intentional.
Yeah, exactly. And that's one of the reasons why fraud is hard to prosecute, because you have to, you have to show intent. There's actually there was a case about that, there was a very large case about it, but you have to show intent. It can't be, oops, I made a mistake here. I filed this incorrectly. I put the wrong date. I put, January 17th instead of January 27th. Those are all mistakes. To be a fraud, it has to show, you have to show some sign of intent that someone intended to do it. And that can be hard. It can be hard to show that, oh, this is what this person intended to do. Okay, type 1 fraud. This is financial statement fraud. Cooking the books. So the first type of fraud is financial statement fraud. The second, type 2 fraud, is kind of funny. Well, the misappropriation of assets, commonly known as employee theft. I like that term, misappropriation of assets. I'm gonna take this money for myself. I'm going to misappropriate it to myself. So financial statement. So type 1 fraud is financial statement fraud. Type 2 fraud is employee theft. Which one of these do you think auditors, external auditors, are more interested in?
Type 1.
Type 1. This is the one they really look at, because this is what they sign off on. You're signing off on those financial statements. Type 2 fraud, misappropriation of assets. While you're looking at that, it has to be material. And you take someplace like Walmart, well, you're talking about in the tens of millions to be material. So it's very unusual to have, for larger companies anyways, larger clients, it'd be very unusual to have an employee that can take that can make a material impact on the. It's possible, but it's generally not. Usually, financial statement fraud is usually what they're looking for. Okay, compliance with laws X. Those that have a direct impact, objective effect on the financial statements, these are more important. Than indirect. An example would be tax violations. And what are we doing here? So direct effect are more important than indirect. So a tax violation. A tax violation is going to affect your income statement. If they're cheating on their taxes, it's going to mean their tax expense is too low. It has a direct impact on their financial statements. So this would be a much more important one than, say, other laws that are indirect. Yeah, what I do here. For example, EPA stuff. Now, it's true that an EPA violation can lead to a fine, but that's somewhere in the future, and it's hard to estimate what that would be. Sometimes it's just clean it up, sometimes it's knock it off, sometimes it's an actual dollar fine, but it's not usually direct. It doesn't, I cheated for this amount and this made our income go up by this amount of money. So these ones that are indirect are much more variability to them. And sometimes there's not any direct impact on the financial statements. So sometimes there's really not, it's not a big concern. I'm not saying for the environment it's not, but I mean, it's not as big a concern as those things that directly impact financial statements, because remember, you sign off on the financial statements. Responsibility for detecting illegal acts. Responsibility for detecting illegal acts is the same as any other responsibility. It must be material. So illegal acts that are immaterial, we generally don't do anything with. Let's say the CEO double parks in the alley illegally every single day. Well, it's, well, it is being a jerk. I mean, it's probably not material. Okay. Responsibility for reporting evidence of illegal act. Okay, this is a little bit tricky. Let's stop here. Okay. So reporting responsibility for reporting evidence of illegal acts. Okay. Step one. Oops. Inform management and the audit committee. You do not go to the police. You don't call the FBI. You have a fiduciary duty to your client. So generally speaking, you inform the management and the audit committee of illegal acts. Now, hopefully they'll act appropriately. If oops. Okay. If management and the audit committee do not act upon the information, so you give them the information, okay, here's an illegal act that's happening. And they don't act on it, or they don't act appropriately on it. You know, something really bad, and they say, okay, well, we'll give them a good talking to or whatever. Okay, it depends on if they are issuers or non-issuers. Okay. So step two, this is for, we'll do non-issuers first. This is going to sound like a complete cop-out, but this is what you do. You get a lawyer. So if they're non-issuers, you get a lawyer, and the lawyer will tell you what your options are. Yeah. You can't simply leave a client. You have professional standards that, you know, well, certain things you can and can't do. As far as going to the authorities, you've been given confidential information, and that confidential information cannot readily be shared with law enforcement in some cases. It really depends what it is. You need to get a lawyer to let you know what your options are. Now, if it's a issuer, it's a little bit easier. Oops. So if it's an issuer, so if you're an issuer, you contact the Security Exchange Commission within 24 hours, and at that point, it's the Security Exchange Commission. And by the way, one of the reasons why this is there is so that companies do act. You tell them, look, either you do something or I got 24 hours. And you know, and by the way, if you don't report in 24 hours, you're in trouble too. So if you find a serious illegal act, tell the company, inform the management and their audit committee. That should do it. If it doesn't, if it's an issuer, you got 24 hours, you have to contact them within 24 hours of you telling them and them not responding. So it's a hard time period, and hopefully the whole idea behind this is that a company will react immediately, and you know, and try to come up with some an appropriate response, whatever it is. Question on that? Okay, well, we got a little left for next week, but okay, let's stop there. Oh, wait. Forgot to write stop. All right, well, I don't know if you guys are probably aware of this, but we're having problems with Blackboard. I'm not sure if they got hacked or what, but earlier today nothing was working on it. But hopefully that's hopefully they'll get it. So anyway, for next class, we'll stop right there. We'll stop there. That's enough for this one. Nothing to turn in. We didn't finish either of those, the two handouts. Next week we'll finish the chapter 1 and 2. We'll also I'll also give you some multiple choice questions, and that we'll go over. It'll be on the test. And those multiple choice questions, you get the chance to earn extra credit points if you come to our little meeting here. Next week we'll finish up chapters 1 and 2. We'll have some multiple choice questions that will give you guys a chance to earn some extra credit points, and we might do a little bit more work on the actually we may even just finish that this classical sampling one, and that'll kind of clear the deck so we can start into chapter 3, which is a real fun one. So okay, nothing assigned for next week. And I will see you guys in a week's time. Right.
A question, Professor?
Thank you.
Yeah.
Yeah, sorry, I couldn't remember if it was you said this last week or another professor, but it typically takes up to 2 days for the recording to be available.
Yeah, I usually can get it in by midnight, but I tell people within 24 hours just in case.
Gotcha.
But and most of that is due to YouTube. I put it into YouTube because I needed to get closed captioning on it. It's the best for closed captioning, and that's a American Disabilities Act requirement. And so that's why I go through the YouTube. And YouTube is funny because sometimes it'll go through, it'll be done in 15 minutes. Sometimes it'll be 6 hours. But it's really out of my control. But yeah, so these will be posted usually by midnight or 1 o'clock in the morning, the same tonight. Otherwise, they'll definitely be up by tomorrow.
Okay, great. Thank you so much.
No problem.
Have a good evening.
Good night.
Good night.
Bye, good night.